So nice place to take a quick breather.
Yeah. Cool.
Are you still running?
Not a huge amount, not as much as before. So every now and then I go out, maybe once a week or so, but I don't know, time just takes over, between the kids and everything. Yeah. Probably playing more football than running, I'd say. Or soccer.
Oh, that's good. Yeah,
my son.
That's a good run right there. You can easily do 10 kilometers in the midst of the field.
Yeah, that's like high intensity interval training almost, yeah. But you feel your age after a while when you're, my son's 15, it's...
Well, they can humble you, for sure.
Yeah.
That's fun, though.
Yeah.
Yeah, they put in some soccer pitches near my house, and I'll go out there and do sprint training out there, and it seems like the fields are longer and longer.
Yeah.
Get down the trail. Ben, we're ready to get started. I think whenever you're ready.
I think we're ready to go, Mr. Gage. Thank you very much.
All right. You want to go ahead and turn us on here? Give us the intro.
Good morning and good afternoon. Welcome to the webinar, Managing Global FX Risk. Just a few things before we begin. You are in listen-only mode. Please post any questions into the Q&A box, or if you're listening on LinkedIn or on YouTube, in the comments box. Thank you for joining us live, and we'll pass it over to Andy and Bilal. Thank you very much, gentlemen.
Great. Well, thanks, Ben. And we're really looking forward to today's session here. It's a little late in the quarter versus when we typically do these things, but it's been a busy start to the year for a lot of people as they've finished up their corporate earnings and getting the year kicked off here. But as always, we have a jam-packed agenda here, and kind of a look back, but also a look forward at the same time. And with us today, I brought yet again Bilal Hafez, the CEO of MacroHive, who is a wonderful resource for us to be able to have in these sessions like this. And Bilal, why don't you take a moment here at the outset here and just introduce yourself and the firm, and then I'll talk about sort of setting the table here for the agenda. But I want to make sure everybody gets to know you and what your firm is available to help corporates as well as investors in understanding the markets.
Absolutely. Thanks, Andy, for that kind introduction. Yes, so in terms of my background, I started along with a few others, MacroHive, back in 2019. We've been going for about 3.5 years now, and we provide advice, research, and advisory services to institutions, whether they're corporates, asset managers, hedge funds, and so on. And just for your reference, before MacroHive, I used to run research at Nomura, the Japanese bank in London, and before that, I had a very long stretch at Deutsche Bank, where I ran various research groups, including foreign exchange research, both in London and in Singapore. And I started off at JP Morgan in the early 1990s. But essentially what MacroHive does is we provide independent, high quality research views to corporates as well as financial institutions. And the idea is that we try to be a partner to organizations, help you navigate these quite treacherous markets at the moment. How much further will the central bank hike rates? We have economists who look at that for the US, Europe, for Asia. Will we have a recession or not? And all of these sorts of things. And if you want to find out more, just go to our website, macrohive.com. You can look at some of the things we're doing there, and then you can enter your email to get access to some of our content, and then we can reach out to perhaps talk a bit more. But yeah, do feel free to go to macrohive.com to find out more. And as Andy said, we do work quite closely with Kriba as well.
Thanks for the quick background, then, Bill. Also, my name's Andy Gage. For those of you who haven't met, I oversee the FX solutions here at Kriba, and spent the last 15, 16 years helping companies really leverage technology to help them automate and optimize their FX programs. And I think we're at a really interesting juncture in the markets right now. And the way we're going to work through the session today is, as we've done on these type of sessions in the past, I'm going to have Bilal really walk through a lot of the technical macroeconomic issues that are really creating a very challenging market for corporate risk managers. And then I'll spend a little bit of time just recapping what we've seen in terms of how these currency gyrations have really impacted companies, fairly significantly over the last year. And then, what are we seeing coming out of that in terms of applicable best practices to help navigate this very challenging market. And this is an unprecedented market. I think as you listen to Bilal's section here, I think you'll understand why we're in a different world than we were a year and a half ago, and this is a world that we're going to be in for quite a while. So, Bilal, why don't we start into your section here? Now I'll just advance the slide.
Great, thanks a lot, Andy. Yeah, so the overarching theme, if I had one, is that we are in a new regime now, and it will last for a number of years, if not longer. And the key thing that's behind this new regime is inflation. So if we just look back and at the history of inflation and start with the US, this first chart on the left in this slide shows you US inflation, headline inflation, so overall inflation. And as you can see, recently, that inflation has surged higher to around 8-9%. It's come down somewhat over the past 3-4 months, but it's still very, very high. But importantly, if you look back historically, what you find is that between around 1982, 81, 82, up until 2020, so just before COVID, inflation would generally hover between 0 to 4%, plus or minus. That was roughly the range inflation was in. So that's around 30 years where inflation was relatively well behaved, and that's the environment we've all got used to. And so there's a big temptation for everybody in the markets, whether that's smart investors, whether that's corporations, to expect that this spike in inflation that we've seen over the past year or two is temporary or transitory, and that will go back to where we were over the past 30 years. My view and our view as a team is that it's not so easy. In fact, we think that there's a strong parallel to the late 60s and early 70s and 70s as a whole, where inflation persisted higher for longer than everyone thought. So if you look at that chart, what you see is as we go into the late 60s, inflation picked up, but it continued to pick up over the 70s, and it carried on rising. And so 70s was a terrible decade for inflation, and it took some quite extreme actions by policymakers, by central bankers to bring inflation down. And so we're in that environment now, and I think that this is something that people are underestimating, the persistence of inflation. The chart on the right in this shows a breakdown. So this time what we do is we exclude oil, food, so get rid of commodities, and we also get rid of goods prices to just look at services. The US economy is primarily a services economy. So services is really where you want to see, is there inflationary pressures in that part of the economy, or is it coming down? And if you look at that, it's still rising and at elevated levels. There's no real evidence that services inflation has fallen or not. So as you can see in that chart on the right, we're outside of the range for the last 20-30 years. We're still rising, and it's still at high levels, and we're still kind of in the zone of high inflation. And so this is one of the overarching things we'd like to emphasize, that inflation is still very high. It's likely to be more persistent than people think. Now, this is not just the US phenomena. If we look at the next slide, we see that other countries are also facing high inflation as well. If we look at Germany, Germany's famous for being a low inflation country. But there you find that headline inflation is actually higher today than it ever was in the 1970s. There was only a period after the war where inflation was higher, after the Second World War, but current German inflation is actually higher than where it got to in the 1970s. And recently, we've had a slate of European inflation numbers which show that core inflation continues to be elevated in Europe and is sticky. That's partly because inflation is spreading from energy and food into other parts of the economy. Then if we look at Japan, Japan, of course, is the classic deflation economy. They never had inflation, at least for the last 20 years, but now we are starting to see inflation. So the chart on the right shows you core inflation. So this is excluding food and energy. And what we see there is that inflation has finally gone back to the 2% rate that the central bank has always wanted. So that's the highest since the 1980s, when Japan had a normal inflationary environment. So even Japan, the country of no inflation, is starting to see inflation. So the backdrop, the numbers all show we're in a high inflation environment. Now, why are we seeing this high inflation? And for me, a large part of it is the labor market. Now, if we think about COVID in many ways was a sectoral shock. What I mean by that is when COVID first struck and we had all the lockdowns, that shut down the service part of the economy, and only the goods part of the economy was still functioning. And so what you saw immediately after that period was goods prices went up. We had supply chain issues, and then we saw lots of goods inflation. But now that the lockdowns have been lifted, goods inflation is starting to fall. But now we're starting to see services inflation as everybody goes back to restaurants and goes back on holiday. And this is clearly seen in the labor market. So this chart is very detailed, but the main thing I wanted to show here was that the bars on the left side, which are highlighted, are parts of the economy that were linked to the goods or the tech sector of the economy, which did very well during the initial outbreak of COVID. So what this shows you is that currently, today, there are more people employed in the tech sector, in warehouses, and in the financial services sector than there were before COVID. And that's why the blue and orange bars are positive. That means there's more people employed versus before COVID. However, if you look at the other highlighted areas, which are negative, which are downward facing bars, you see that nursing, the culture sectors, hoteliers, restaurants, plumbers, there are less nurses today employed in the US than there was before COVID. There's less plumbers today than there was before COVID. And so this really goes to the point that we've had this sectoral shock in the economy, and something happened to the labor market whereby the service sector is booming and there's not enough workers in that sector. Now, why is that? One reason is some people dropped out of the labor force, either out of sickness or because of early retirement. Second, immigration stopped, so there was less immigrants to be able to take on these roles. But then also people are starting to demand much higher wages to re-enter the workforce. And this is where we think we could see a real inflationary wage price shock to occur. This is one of the reasons why we think that we will see more persistent inflation going forward, because the service sector still has this labor market imbalance where you don't have enough workers in the service sector. And in order for companies to attract those workers, they need to offer higher and higher wages. Now, what does this mean for the Fed? If we go over to the next slide, what's interesting is the Fed has raised rates to 4.75%, which is the chart on the left. Now, the Fed has raised rates very rapidly, but at the same time, we also have to remember that inflation increased much more rapidly than we've ever seen, at least since the 1970s. But even at 4.75%, we think that's still too low. The market expects the Fed to raise rates to 5.25 later this year, or maybe 5.5. But in our view, we're more likely to see the Fed go up towards 7 or 8%. Now, why is that? One basic reason is that if you look back historically, and if you look at this chart on the left, you see that in 2006 and 7, the Fed raised rates to 5.25%. And that was a period in the 2000s where inflation was lower than where it was today, and the unemployment rate was higher than today. Then if you go back to the Greenspan period, so the late 1990s, early 2000s, Greenspan raised the policy rate to 6.5%. And again, inflation was lower back then than today. And so our contention is that the Fed needs to raise rates more than it did in the 90s and the 2000s, because inflation is simply higher and the unemployment rate is lower. Now, Volcker raised rates to 20%, which is the high point in that chart back there in the late 70s and early 80s. Now, we don't think they'll go quite up to 20%, but nevertheless, it does show you that people are too recent in their comparison periods for the Fed. You know, they shouldn't just look back to the 2000s and the 1990s. You have to look back at earlier inflationary periods to get some kind of reference to how far the Fed could go. So we would not be surprised to see the Fed going up to 7-8% during this cycle. It may not happen this year, it may happen next year, but this is the environment and the type of regime that we are in. And just as a side point, I did want to talk about where leverage has been building up in the system since this era of low interest rates. So the chart on the left, shows you that the Fed cut rates to around 0 after the global financial crisis in 2009 and kept it pretty much close to 0 up until COVID. So what happened? Where did the leverage build up in the system? The chart on the right shows you leverage through banks, the blue line, and leverage in what we call shadow banks, the orange line. And so what you see is that since 2008, we've seen a massive growth in shadow banks. And shadow banks here is anything that's not regulated like a bank that offers credit in some form. So this, for example, could be a money market fund that offers credit in the sense that if you buy a money market fund, in essence, you're buying corporate paper, commercial paper where you're lending to corporates. It could be private equity or private lending, where private institutions lend directly to another entity. And so what you see is the credit has really pushed into the shadows. And so this is probably the area we need to focus on the most. This includes things like crypto as well, which will really start to come under pressure as the Fed continues to raise rates. So all sorts of private lending, private credit, corporate bond issuance, all of these sorts of sectors are the ones that are going to come under more and more pressure as the Fed starts to raise rates. So that's just a side point about some of the risks to look out for. Now, what does this mean for growth? If we go to the next page, we have two conflicting forces on the growth side. The chart on the left is our model that we have at MacroHive, which shows you the probability of a US recession occurring in the next 12 months based on the US yield curve. So we know that the US yield curve is heavily inverted, which means that short-term interest rates, like 2-year interest rates, are higher than 10-year interest rates. And currently, our model suggests that there is around a 90% probability of a US recession occurring in the next 12 months. So our base case is that we do think there's a high chance of a recession later on this year or possibly early next year. So in that zone, we think that a big reason for that recession will be the Fed, that the Fed will have to end up raising rates at a level which induces a recession to bring demand down in order to bring prices down. And this is, in fact, what the Fed always did before the 1990s. It was typically the Fed that caused recessions in the earlier periods historically. In more recent years, it's been asset bubbles bursting that have caused recessions. We think this time it will be the Fed. So that's the one gloomy, one negative story. The one positive story on the other side is China. So China essentially reopened in December, and we think that people are underestimating the growth impact of the China reopening. The chart on the right here shows you our high frequency measure of China reopening. So this is things like people going to the cinema in China, people taking the subway, number of boats coming to ports, all of these sorts of higher frequency measures. These have all started to surge higher at the end of last year and coming into this year. So for us, this is a sign that Chinese growth will be way, way higher this year than last year. Last year, Chinese growth was around 2 to 3%. This year, it could be double that. So there is a potential silver lining here that Chinese growth could be much, much stronger than people think, even as the US growth starts to falter somewhat. So we have kind of two sides to the growth story, which then has an implication for currency markets, where we think Asian markets and EM in general may actually do relatively well on the FX side early on this year, thanks to this type of dynamic. Now, if we step back and look at the dollar overall, one thing we have to bear in mind is that the dollar is very overvalued. So this is the trade-weighted dollar going back to the 1960s. We've adjusted for inflation here to make the comparison fair. And what we see is that the dollar last year reached its highest level. It overtook the level it reached in 2000 when the dollar was last at a high. That was when euro dollar had fallen to 82. And we're almost at the levels we saw in the mid-1980s, where the dollar was very, very strong. What this tells me is that from a cyclical or valuation perspective, the dollar has some downside risks on a multi-year basis going forward. So while obviously if the Fed goes to 8%, the dollar will rally, but there'll be a limit to how much the dollar can rally, because it's trading at very elevated levels. So this tells us over the next 5-6 years, we could start to see a dollar downtrend start to occur. And often at these turning points in the dollar, you tend to see much more volatility in markets, as markets aren't quite sure whether they should go with cyclical forces in the dollar or whether they should look at the valuation factors on the dollar. So you often get these big kind of periods of uncertainty, and volatility tends to pick up around those turning points. So this is something I wanted to flag as context. Now, if we go to individual currencies on the next slide, what we see on the chart on the left is that the euro has steadily been falling on the chart on the left since the global financial crisis. From 2015, we stabilized and we entered this broad range, but obviously last year, euro had another big drop, but we didn't quite reach parity. So right now we're trading around 105, 106. A big debate in markets right now is whether the euro will have another lurch downwards to break parity or whether we've seen the low in the euro. Our view is that we're neutral right now at these levels. We'd rather be tactical to play both sides. Interestingly, even as the market is seeing the Fed become more hawkish, they're also seeing the ECB become more hawkish as well, which could end up seeing the rate differential move sideways rather than clearly in favor of the US. So we may not necessarily test the low in the euro, but as we are still not too far away from parity, there will be a lot of uncertainty about the direction of euro dollar. If we look at dollar yen, of course, last year we saw this surge above 114 dollar yen as the Fed was hiking, the BOJ was doing nothing. And this year the picture is different somewhat. You know, we still have the Fed hiking, but there's a real chance that the Bank of Japan may also make some adjustments to its policy. So that starts to introduce some more two-way risk for dollar yen as well. And then when we look at dollar China, the renminbi did strengthen as we came into this year and the beginning of this year, but over the past 4 or 5 weeks, it's given back some of its gains. It's not too far away from 7, so dollar China's been rising, so dollar's been strengthening, renminbi's been weakening, it's heading towards 7. Our view, though, is that dollar China should start to head back down, you know, towards 680, maybe 670 over the course of this year. So together, this tells you that we're at very important turning points for the dollar. And this year is going to be a very pivotal year to establish the trend in the dollar for the next few years. So this year will be a very important year to sort of break that deadlock. Now, finally, I did want to talk about volatility, which is on the next slide. And I mentioned earlier uncertainty and volatility. And the chart on the left shows you the blue line is 12-month realized volatility in euro dollar. So this is how volatile has euro dollar been over the past 12 months. And what you see is it spiked higher recently because, of course, euro dollar was falling towards parity. So volatility really started to pick up. But if we look at a longer window of, say, the past 5 years, which is the orange line of volatility, it's been falling. So on a rolling 5-year basis, volatility has been falling steadily on a successive basis over the past 5-10 years. Our view is that volatility on a multi-year basis has probably reached a low, and we are probably likely to see realized volatility in euro dollar head back up, so that the average volatility in euro is closer to 10-11% rather than the 6-7% that we've been used to for the last 5 to 10 years. And so this is a big regime change that we're likely to see. And part of this is to do with interest rates are much higher than before. Part of it is to do with a turning point in the dollar overall. You get heightened volatility. And then part of it also is that as you start to get higher interest rates, there's more scope for divergence as well. So one central bank could continue to hike, the other may stop hiking, and then you get a rate divergence story. There's a similar story in dollar yen as well. The chart on the right, the orange line, which is the last 5-year volatility, has been falling steadily down towards 7. We think again we should head back up towards 10-11%. So on the next few years, we should start to see a new regime of higher volatility in markets. And just as a final point, one of the reasons FX volatility did get crushed was that interest rates fell to 0 across the world. And when you move to 0 across the world, then it really reduces volatility in FX because there's less scope for downward moves in interest rates because they've hit the lower bound. And if they're stuck at zero, then you don't have a rate divergent story. There's no carry trades and such. Our view is that as we have entered this new higher inflation regime, we're now in an environment where it's very, very unlikely that interest rates go back to zero. We had this very unusual period after the global financial crisis where inflation stayed very low. On top of that, bank balance sheets were very constrained, so the central bank had to step in to create more credit in the system. But we think those two factors are turning. One is inflation's higher. It's going back to, at the very least, where it was in the 90s and 2000s, if not the 1970s. So that makes it much harder for the Fed to cut rates to zero. But also there's a lot more credit available in the system compared to before. Bank balance sheets have been repaired. They're more able to extend credit than before. So the central bank doesn't need to necessarily pick up the slack and take on the role of a credit intermediary. So going back to zero, I think in our view is very, very unlikely, which again goes back to this idea that volatility should be higher. So just to reiterate, the main points here are that we're in a new regime. It's higher inflation. There's imbalances in the labor market that will keep inflation high. The Fed will probably end up raising rates more than everyone thinks, possibly to 7%, maybe to 8%. We're likely to see a US recession later this year. There is a silver lining in China reopening, at least early on this year. The dollar is in a very pivotal point, and this year could break the deadlock as to whether the dollar overshoots to the top side or whether it starts a downtrend. And we think we're in an environment of heightened volatility now that could last for years and years to come. So with that, I'll hand back over to Andy, who can take it from here.
Yeah, thanks, Bilal. I think that's really valuable insight into some really complicated market dynamics out there. And yeah, I think your point about the the increasing volatility and the shifting interest rates, I think is really an important point for CFOs and treasurers and corporate risk managers, because a lot of the hedging programs related to currencies, in many cases were established and developed in a low or zero interest rate environment. And you've got a lot more dynamics to deal with here. We're going to kind of see how that plays out here. Before we do that, let's take a moment here, and we're going to have Ben take us through a quick poll question here. So, what best describes your FX hedge programs as of late? No issues at all, performing at or above expectations. A couple of known issues in process of fixing. A couple of known issues, no resources to fix. Underperforming and struggling to identify the issues, and just unlucky, a new one-off surprise dings us each month. I'll give that a moment here. I think in general, the research in the conversations I'm having with clients, it's been a messy year last year as it relates to FX, due to the surging volatility and the challenges in different regions, as well as the increase in cost of hedging here. So I'd be really interested to see how the results of this come back here. Just give it another couple of seconds here before we go on. All right, Ben, we ready to show the results here? Okay, so I think in large part here, there's definitely some room for improvement here. We do have a number of companies that, about 20%, that are relatively satisfied with their environment, but we definitely see some challenges out there where companies are trying to deal with a lot of the issues. And I'm going to get into many of the issues here that I'm seeing as I engage with clients. So thanks for that, Ben. Let's go ahead and jump into the next section here. So where we're going to go from here is we're going to start taking a look back at what we saw coming out of the latest currency impact report that was released by Kyriba. As you, for many of those that monitor the FX results that we provide, we've seen a pretty significant impact here, and this again is about a quarter in arrears from where we are. But last year, Q3 of last year was really at back to Bilal's slides, was sort of at the high point of where the dollar strengthening was. And no surprise, this was the largest aggregate impact that we had seen to corporate earnings due to primarily due to the strong dollar. And you can see that graph there, just the steady rise and impacts that we saw throughout last year. And it definitely caused a lot of headaches for a lot of companies out there. And the U.S., well, we're certainly seeing the largest impact out there. There were some companies that did see some tailwinds, primarily in Europe, or depending upon which way they were facing the markets there. So it was a combination of significant headwinds in North America, with some tailwinds in North America as well as in Europe there. But I think as Bilal kind of laid the framework out here, the headwinds and the tailwinds could change significantly, depending upon if the dollar does start to come back off its highs and start to depreciate as it relates to the euro. You could see this flip, and we could see more headwinds and headaches in Europe as it relates to the euro dollar. That's generally the largest trading exposure for a lot of corporates. So we could be seeing a lot more challenges in the European theater coming into the latter part of this year, going into next year as well. But as we go underneath the covers a little bit more here, you can see here very distinctly the dichotomy between what we were seeing in North America results and European results there. So you can see a very significant Q3 impact, almost predominantly headwinds for North America, just given the extremely robust dollar that we saw. And it was on the heels of two successive impacts coming from Q1 and Q2. So it'll be very interesting as we recap what we saw in Q4 to see how that plays out there. But as that dollar strengthened, you could see in the European sector of our research here, we certainly saw them benefiting from a bit of a tailwind there. Not to saying they weren't seeing FX noise that was going through to the bottom line and causing some headaches there, but it was a bit easier for them to explain the results as they were somewhat working in their favor. Now that absolutely can change in the next 24 months here, and we can see a very different set of circumstances as the markets play out here. So when we look at what currencies are impacting corporates here, one of the things that's really interesting is the constantly shifting set of currencies that are impacting corporates here. So if you look back here, this is the most recent results here at the top going back. You see a constantly shifting set of currencies that are out there. Right now, Argentina, Korean won, the sterling, ruble, which was certainly a headache in Q2 and Q1 of last year, certainly related to the conflicts in the Ukraine there. But you've seen a constantly changing set of currencies over the last several quarters here. From a corporate risk management standpoint, what that should draw your attention to is don't fixate on your largest exposures. This is a conversation I'm having with a lot of our clients right now, which is, historically they may be thinking about the largest, most visible exposures, but you never know, especially in this very turbulent market environment, where different currencies can come up, and the relative size of the exposure may be somewhat small, but the risk associated with those currencies could be significant enough to cause some headaches there. So this is something you always have to take a very holistic view of the exposures that are sitting within your portfolio of currencies that you're doing business in. Now, from an industry sector standpoint, this is always an interesting view into what type of industries are being most readily affected by the impact of currencies here. And so if you look back over the last trailing year here, you've certainly seen a lot of industrial manufacturers historically taking some significant impacts there. But now you're starting to see more companies in the healthcare and professional services, certainly in biotech, that are definitely seeing the impact as well. So again, very few industries are immune from the impact of currencies on their financial results there. And again, it doesn't take much to where the markets move against you, where you were in an industry that was somewhat insulated, where now you're at the front line of being one of the more impacted industries out there. And we've definitely seen a lot of manufacturers taking some significant hits there due to the combination of the strong dollar, the volatility, as well as some of the supply chain disruptions that have made liquidity within their working capital and their supply chain additive to the FX challenge that they've been dealing with here. So this is a real issue for North American companies that they're facing out there. In Europe, a bit of a shift here, which was a surprise for me. Historically, the research has shown that biotech in pharmaceuticals has been sort of the leading sector that has been most impacted by currencies. But here you can see, the electronic equipment moved up. We certainly see chemicals moving up there. And again, this is in large part due to the deep supply chains that these organizations have, which makes them more vulnerable as they're trying to move products and they're buying and selling intercompany in different currencies. And that adds to the headaches that they're seeing out there. So again, very, very challenging environment that corporates are dealing with. So here's, taking that all in and also taking into consideration, the details that Bilal provided out there. Our conversations with the market are really focused on what do you see? What issues are you dealing with here? Now, one of the things that my team routinely does is we have a representative set of data that we look at that kind of helps us understand how companies are being impacted. So we'll run this through our analytics here. And this is a 12-month retrospective of the top 5 risky currencies, a gross value of risk analysis on this portfolio of currencies that we're looking at here. And you can see as we've gone through the last year, and basically the more recent is at the front of this, and you've got older stuff in the back there. You're starting to see some volatility re-enter the market here, and we see some challenges. Actually, it's the other way around. So you're looking back over a year. So the left is more historical, the right is more current time here. So certainly saw that peak in the third quarter and early part of the fourth quarter, but we're not out of the woods here. We're seeing volatility creep back in here. Let me give you a nice graphical representation of this. Using that same set of data here, this is an analytical package that looks at the relative risk within the currency portfolio of this company. And this is designed off of a typical manufacturer here. And when we took a snapshot at the end of the year, we were looking at an aggregate risk, and this is an uncorrelated VAR. It's just a parametric VAR here. We can look at it on a correlation basis if anybody's interested. But we were seeing about a $35 million aggregate risk for this portfolio of currencies. Now, if you look to the far right there, the bottom axis of this analysis is looking at the cost of hedging. So we're looking at the impact of the interest rate differentials that have been fluctuating here. And we certainly saw in the second quarter and third quarter of last year a significant cost of hedging. And here you can see cost of hedging here is just north of $1 million, about 1.3 million for this portfolio of currencies here. Now, if we move this forward into the first part of this year, January, we saw a little bit of risk coming off, a little bit of volatility come down, and as the interest rate differentials are moving around here, and to Bilal's point, you're starting to see the ECB start to intervene with their interest rate hikes. They're trying to play some catch up here, and there's this tug of war between ECB and the Fed in terms of their interest rate hike here. The benefit for the portfolio here is that we saw a bit of risk reduction, and we saw a little bit of relief in the cost of hedging here. Certainly not where we were, more than a year and a half ago, but it was coming off a bit here. And if we come to the latest snapshot we did in the end of February, we're seeing the risk moving back up again. So the risk is moved back up closer to 33 million. But again, we're seeing a little bit of relief on the hedging costs, which should give CFOs and treasurers a bit of hope here. Now, that again can change, and that's why having these types of analytics at your fingertips and being able to assess the overall risk within the currencies you're doing business in and what the relative costs are is a foundation for setting and managing expectations on, here's what we're faced with, what do we want to do given the circumstances here. Now, here's a few things that as I'm talking to the markets out, or talking to clients. These are some reoccurring themes that I'm seeing in just about every conversation. One is for those companies that haven't really invested in technology to help them get their arms on their underlying exposure, there's a real appetite to improve the timeliness and accuracy of exposure definition. Whenever we see these surges in volatility and the impacts that we've seen, we usually see CFOs start the year with a mandate for their treasury and their FX teams to do a better job. And a lot of that starts with the beginning of the process. I need good data. I need to understand what my exposures. I need confidence in that. If I don't have confidence in those exposures, there's very few things I can do that I'm not going to be concerned about, and I may have a tendency to hedge my hedges, which is always a difficult situation, certainly in the current environment. The other thing that I'm seeing, and this is a playbook that my advisory team has been playing out there, is look inside before you look outside. Really focus on those internal actions. Look at what you can do, and I'll give you some examples of that. So I'll leave that point for a moment there. The other thing I'm seeing is a strong mandate to further digitize and automate the FX process wherever possible. They want to eliminate the reliance on spreadsheets. They want to eliminate the reliance on key person risk. I've seen some corporates that were faced with some very difficult situations where they had these elaborate, hedging programs that were tied to one person and one spreadsheet. And when those people left, they were in recovery mode. And that's, again, not a situation that CFOs are comfortable with, of losing that insurance that they're going to be able to manage those currencies to the best of their ability and not be tied to one person or one set of spreadsheets. The other thing that we're seeing there, and this is, I think, really a very important point here, and we're actually going to be discussing this at Kariba Live in early April. One of my clients, Align Technologies, is a perfect example of doing everything in the playbook, which is knock out the exposure organically, seeing where you can do some operational hedging, but they're still left with a significant challenge in terms of managing that increasing volatility in the challenging hedging cost environment, where they're starting to think differently about how they want to approach their hedging. Some of that may involve more sophisticated portfolio VAR and cost of carry type of analytics to help them find more optimized ways to reduce the cost there. And the last thing that we're seeing is a really increased appetite for really strong reporting and analytics. In this type of a market, the CFO and the C-suite, the CEO in general, they're asking for better insight into what's happening out here. And I think given what Bilal painted in terms of a likely scenario coming out over the next several years here, this appetite's only going to increase, because there's just no way to go into this very complicated challenge around currencies without really strong analytics and reporting to help manage and set expectations and explain where things are still challenging, either from a volatility or from a cost of hedging standpoint. So let's take a moment here and talk about what we're seeing. And I'm going to kind of pull this apart from a couple of different angles here. One, from a balance sheet standpoint. What I mean from a balance sheet hedging standpoint, very simply, I want to be able to manage the FX results off of the remeasurement of my monetary assets and liabilities, cash, accounts receivables, accounts payable, intercompany payables, receivables, short-term intercompany loans. Those are one of the things that we're seeing out there is different appetites depending upon the rate environment that companies are dealing with. So if I'm in a daily rate environment, what I mean by that is each day your ERP systems are updated with a rate of the day, and you have an additional challenge there where your exposures and your rates are changing every single day. Best practices and best results have been attained by really automating that exposure capture and allowing much more frequent monitoring of the net exposure and adjusting to the market dynamics and the exposure dynamics that are happening within the business. We've had clients have great results when they stay right on top of that. In a monthly rate environment, which is basically setting those accounting rates at the beginning of the month, so as transactions are happening for payables and receivables, they're done at the same rate. The appetite that we're seeing out there is really to revisit those exposure forecasting methods. In a monthly rate environment, the general practice is I'm going to set a rate at the beginning of the month, and I'm going to try to put my hedges on as close to when we set that rate, which implies I'm going to need to forecast what I think my exposures are going to be at the end of the month or the end of the next month, or however far out you want to forecast. And so companies are looking for better controls around that forecast. In the past, we've seen a variety of techniques of using people in the field to generate the forecast of what they expect for their part of the business. We've seen the indirect method of trying to anticipate what's coming through the income statement. We've seen automated analytics that can go back and look at regressive behavior within the exposures as they've evolved over time. Whatever the right methodology, given the rhythm of the business, it's really important to continue to focus on that and take forecast error out of that, because it's very expensive to make mistakes out here. And another key part of this is a really strong appetite to continuously dig into multi-currency accounting issue. So what do I mean by multi-currency accounting issue? It's very common for the people in the field that are recording transactions in the ERP systems to book and relieve transactions in different currencies incorrectly. The net effect from a corporate risk management standpoint is it can end up causing you a lot of headaches trying to understand why we're seeing all this noise that doesn't make sense. Am I hedging an exposure that's not real? Do we have intercompanies that are not reconciling? The key thing is there's analytics that can help solidify the understanding between treasury and accounting, and sometimes the IT organization, in terms of what sort of self-inflicted wounds are we doing, just in terms of some bad practices that have become normal inside of how we're accounting for multi-currency transactions. Those are key things to eradicate. Now, from a cash flow standpoint, again, similar to what we saw in the monthly rate, we're seeing a lot of companies rethink how they forecast their cash flows. Looking at getting better analytics around forecast variances, if they're being supplied from the field, doing forecast to actual variance analysis. Also looking at, can I source data from a common planning environment, whether it's coming from an FP&A system like Anaplan or Adaptive Analytics or out of the SAP analytics there, and using that as a consensus view and driving that into the forecast. So a lot of different activity around just improving the quality of the exposure definition at the front end of the process is paying dividends for a lot of companies right now. Now, here's an example of what I mean on reducing some of the headaches from an exposure standpoint. This is a playbook that we provide. We've actually got some great playbooks and some mini white papers around this. But one of the things we always tell people to do is, if you're trying to reduce exposure, go see where you've got excess non-functional cash balances. Convert those if you can. Settle those intercompany balances if possible on a more timely basis. One of the things you'll hear from some of the companies is they're really examining those intercompany loans that are showing up. The short-term portion is showing up out there. They're rethinking about how they're setting up those intercompany loans to see if they can reclassify them more as an investment for the long term and taking the short-term portion off of that. Again, it has to be proper from an accounting treatment standpoint. But that's a way to take some volatility out, and I've seen some companies definitely looking at that. And I think the other thing that we're seeing is really setting up those natural offsets through the movement of cash balances or actually introducing intercompany loans. At the end of the day, what really helps companies do this is having really good data, obviously, as well as really good analytics where they can do all sorts of different types of scenario analysis. And again, Laura from Align Technology, when she speaks at her Kariba Live, she's going to spend a lot of time talking about this. So if you're a client, definitely encourage you to come to the event there and see how she is actually doing this and having some decent success with that. The other aspect that we're seeing out there is looking at different ways of hedging. We still find a lot of companies that are hedging their exposures on a per entity basis. And this is a graphical representation of some embedded costs that are based on that. So if you look here, you've got two different axes, trading costs and back office cost savings. So if you're doing entity level hedging here, you're in the worst case scenario. You've got the least efficient from a trading standpoint because you're not netting across entities, and you've got the most back office costs because you've got to settle for each entity. Now we've seen some companies get some benefit by regionalizing that, so basically trying to net and settle within a region. But the most efficient is doing it at a company level. So if you're in a situation where you have a corporate trading entity and they can house the exposure at the top of the house and trade that net position, that is the most efficient. But that's not always practical, whether it's tax reasons, reporting reasons, accounting reasons. Companies have to make sure that the results get back to the entity. So there's a few different techniques that you can do there. One is doing the back-to-back with hedging, and you can do that through many of the trading engines like FXall or 360T, where you can block trade currencies on a net basis, even though they're actually tied to specific entities and need to be settled there. So you get some transaction cost savings, but you still have some overhead from the settlement process there. And then the last one is something that we're seeing a lot more companies doing, where your risk management technology is really taking the responsibility of helping you determine what's the most efficient net external trade, and then being smart enough to know how to allocate that back through the results there. So it's almost as efficient as trading and holding the results there. So these are things that we're seeing companies, take a very hard look at, and these can generate some very, very significant cost savings. We had a client where within their European theater, when they implemented this type of approach here, saved €1.5 million in the first year of their trading on a more net basis here versus on an entity basis. So this can yield some substantive results there. So those are some of the key highlights that we wanted to focus on there. And I know we've got about 10 minutes left here. Wanted to open this up for questions. I don't know, Ben, if we've seen any questions coming in from the various chat results here. You online there, Ben?
Did not see any come in, Andy.
Well, I think in summary then, what I think is an important takeaway is we certainly saw a really challenging environment in North America last year. I think that's been a catalyst for a lot of CFOs and treasurers to rethink their programs and see if they can attain better results. And I think given what Bilal shared with us, I think there's an increased urgency for doing that. We're not out of the woods in terms of the interest rate hikes. We're not out of the woods in terms of the changing interest rate environments between various central banks. We're not out of the woods in terms of volatility. In fact, we're probably just getting into the woods on all of those parts there. And so moving past the legacy hedging approaches that were based on that zero low interest rate environment and being more dynamic, being smarter, having better analytics, and rethinking hedging strategies, I think is going to be an increasing urgency and focus for a lot of companies out there. Now, if you're one of those companies that's starting to examine that, we're here to help. We certainly have the technology, but we also have very strong advisory services as well. So if you need to, have somebody that can kind of help you think through the implications in terms of how you're looking at it from a hedge accounting standpoint, or rethinking your hedging program and moving from a exposure-based to a correlated or portfolio VAR-based approach here, we can provide some assistance to you to help not only implement, but also think through and strategize on different approaches there. So with that, I think we're at the end of our program here. Bilal, as always, fantastic insight into the markets. We always appreciate your input. And again, if you're a corporate that's interested in their research, definitely take a look at their website. They've got some great services for corporates. And again, if you're looking to help your organization be better prepared to deal with the continued currency challenges that are out there, you can contact us through the website, or you can request this this presentation. We're happy to go into more depth on that. So with that, Ben, we'll tidy it up from there.
Thank you everyone for joining us today for the presentation. That is the end of the discussion. Look forward to an email from us recapping everything. Have a great day. Thank you.
Thank you.